Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden within corporate filings. Prepare yourselves, because folks, this is a wild one involving SPACs, ordinary shares, and even some rights to shares that still need to be earned. So what is the story today in Invest Green Acquisition Corporation and SPA? C is looking to go public, and wow, they are laying out all the potential ups and downs in this massive filing. If you want to cut through the jargon and understand if this is a diamond in the rough or a ticking time bomb, stick around. We are diving deep into their financials, their business plan, and the serious risks involved. And hey, if you love this kind of deep dive content, make sure you hit that subscribe button and join our Discord community linked in the description below for more exclusive insights. Alright, let's get straight into it. Invest Green Acquisition Corp is a blank check company, meaning its main goal is to acquire another company, usually a private one, and take it public. They are aiming for the renewable energy, sustainable finance, and nuclear energy sectors, which sounds like a pretty hot area to be in right now. The company itself was just formed in April 2025, so it is very new. They are planning to offer 15 million units each at $10 a unit, so that is a $150 million offering plus an extra 22.5 million if the underwriters decide to sell more shares because of high demand. This is a big chunk of change. They want to raise a lot of money to find and buy a company. Now about the money, their sponsor is buying another 480,000 units at a much lower price of $5 each. That is about $2.4 million. This is common in SPACs. The sponsor and insiders get a better deal up front. And this is a big part of their incentive to make a deal happen, even if it is not perfect for regular investors. Let's look at the money they expect to raise and how they plan to use it. They estimate raising a total of $153.9 million before expenses. They plan to put a massive $150 million into a trust account. This is standard for SPACs because this money is meant to be used for the acquisition, or returned to investors if no deal happens. They are spending about $550,000 on various fees and expense related to this offering, which seems reasonable. They expect to use around $350,000 for ongoing expenses like legal, accounting, and insurance. While they search for a company, this is their pocket money to keep the lights on and find that perfect business combination. Now here is where it gets really interesting. The filing mentions that their initial shareholders, the sponsor, and insiders paid a ridiculously low amount for their founder shares. Only $25,000 for over 5.7 million shares, that is less than half a cent per share, but they are offering these units to you and me at $10 each. This means there is a huge difference between what they paid and what you are paying, which leads to immediate and substantial dilution for new investors. This is a critical risk factor. The founders essentially got their shares for practically free, and if a deal goes through, even if the company doesn't do well financially afterwards, they could still make a fortune. This creates a potential conflict of interest. They might be motivated to do a deal just to get their shares converted and cashed out rather than making the absolute best deal for public shareholders. The dilution numbers are dropping even assuming the maximum possible redemptions, meaning most shareholders get their money back, the net tangible book value. Per share is tiny compared to the $10 offering price. This means that right after you buy your shares, the value of those shares in terms of tangible assets is significantly less than what you paid it is. Like buying a product that is worth half its price the moment you walk out the store. Since this is a SPAC, they have no real operations or revenue yet. Their financial statement as of the 6th of June 2025 shows a tiny amount of cash and a working capital deficit. This is normal for a company that is just starting and hasn't found a business to acquire yet. But it highlights the going concern issue, which their auditors also pointed out. Their auditor has flagged substantial doubt about the company's ability to continue as a going concern without successfully completing this IPO, and finding a business to acquire they might not be able to keep operating. This is a major red flag for any investor. The risk section is incredibly long and detailed. They are basically saying over and over again that finding a good company to acquire is hard, and that there are many factors that could prevent them from doing so. For example, if too many people redeem their shares, the deal might fall apart, or they might not have enough cash to close the deal. This is a big deal for you as an investor. You don't get to vote on the deal unless they decide to hold a shareholder vote, and even then your only real power is to get your money back if you don't like it. But if too many people redeem, they might not be able to do the deal at all. Again, the dilution from the founder shares is a huge theme. They are likely to make a substantial profit even if the combined company's stock price drops after the merger. This is a classic SPAC concern, and it is right there in black and white. These founder shares, which were bought for almost almost nothing will convert into Class A ordinary shares just like yours, but they have special conversion rights, meaning they could end up owning even more shares than initially expected in certain situations, which further dilutes your investment. This is important. Their sponsor essentially picks the directors until a deal is done, and this means they have a lot of control over the direction of the company before you even know what company they might buy. The underwriters are also buying a chunk of shares at a discounted price, which is also a way for them to align their interests with the company and potentially profit. Now, looking at this filing as a whole, Invest Green Acquisition Corporation is in a very early stage. Their entire business hinges on successfully finding and acquiring another company in the clean energy space. The management team has experience, but the risks associated with SPACs are immense, especially the dilution from founder shares and the pressure to do a deal within a specific time frame. The potential for conflicts of interest is very high given the low entry cost for insiders. So what is my take? Invest Green is trying to tap into a growing market, but they are structured in a way that heavily favors their early investors and insiders over the public offering investors. The dilution is significant, and the risks of failing to find a suitable target or completing a deal that is not in the best interest of public shareholders are very real. This is a high risk, high reward situation, and for most investors, I would say the reward seems heavily skewed towards the insiders right now. Be very careful if you are considering investing in this one. Alright, that is our deep dive into Invest Green Accession Corporation's S-1 filing. What are your thoughts on this SPAC structure and the numbers presented? Let me know in the comments below if you found this breakdown valuable. Please hit that like button and subscribe for more corporate insights, and remember to join our Discord community for discussions and exclusive content linked in the description. Thanks for watching, and see you on the next episode of Corporate Decoder.